Welcome to the Dividend Talk podcast, episode 163. Why dividend growth investing is better than working a 14-hour day. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavor. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. How are you, my friend?
I'm really, really good, and I love the title of the show because it's all about you today, my buddy. So yeah, no, I find this topic so interesting because I think it doesn't get any better than a pub talk like this because you literally come out of a 14-hour workday. And when you mentioned this as a joke, I really felt like we need to do this in the podcast because this is for many people real life, and that's what our podcast is about. So I'm really looking forward to ask you some questions today. Let's say it like that. So yeah, no, welcome. I mean, I really appreciate your discipline, right? After such a day, still coming on to the podcast and to this recording, also knowing that you will be 2 days out. So it's also a lot of respect to the readers and shows strong discipline. So kudos from my side.
Yeah, we try to be consistent. To be fair, we're not always the case. I think we've slipped in the last couple of weeks with different things, and summer kind of gets in the way. So we try and be as disciplined as possible. So we'll always make time for it. But look, I'm looking forward to getting into it. I did say it to you as a joke as the topic, but I'm looking forward to having a little bit of a wine and a whinge in about 10 minutes time. But before that, let's maybe go into some of the news of the week. And I might start because we all know Walgreens is a company that I've talked about. I haven't covered them in a long time, but I keep getting asked questions on them as they are a part of my portfolio. They seem to be in the news an awful lot lately, and it's hasn't been quite positive, I would say. The CEO has stepped down, the share price has tanked, and now they have agreed to pay 44 million as part of a settlement with Thanos. And you might remember Thanos because I think you pointed me to this book called Bad Blood back in
Yeah.
COVID. And it's worth a read. If anyone's out there, it's definitely worth a read. But yeah, as part of this, they now have to pay 44 million. They were basically duped by Katie Holmes, or is it Katie Holmes? I can't remember her surname.
Katie Holmes is this
Yeah,
famous
it's not Katie
actress.
Holmes. What is that? What's her first name?
Elizabeth.
Elizabeth Holmes. Yes, that's it. So they were basically duped by her, and now it's led to them having to pay 44 million of a settlement about 5 or 6 years later. It's absolutely crazy.
Yeah, but this story is so intriguing, right? This Elizabeth Holmes really scammed everyone, and she had this turtleneck black, what is it? How do you call sweaters?
Yeah.
Because she was inspired by Steve Jobs. She wanted to do how you say it, with a drop of blood to do 100 tests, and in the end, you know what devices she was using, if I remember correctly?
Go on.
Siemens.
Siemens devices.
Yeah, I think they use the Siemens machines in the back office to do the tests. So it shows you the engineering quality there. But she fooled everyone. She fooled everyone there.
Yeah.
Like and I can only imagine this Walgreens board of directors. They see a young lady, entrepreneurial, and they think like, oh, this person, we need to jump on the bandwagon here because this will be a boon to our business, Of course, stepping over all the due diligence and everything. It's like this with FTX, right? Where Wall Street brokers were saying like, oh, we need to invest in this guy because he's playing League of Legends while he's doing a multi-billion deal. This is the real deal, guys. If you can do this, then, and I mean, and then all these banks and also such a company like Walgreens, they have the all those compliance departments. You wonder why they have them then, right?
Yeah, it's crazy. I won't ruin the book for anybody because I think it's definitely worth reading. There's also I think there's like a mini series or a short series about
Yeah,
it on
from
Netflix.
HBO.
But I would definitely read the book first and then
The book
watch.
is awesome,
Yeah,
really
yeah.
awesome.
I think the book is better. But it's just you can hardly believe some of the stuff, the carry on that goes on, and
Yeah.
like they had some smart guys working with them. They could see what was happening, and then they couldn't walk away, or
Yeah.
they've been threatened, or it's worth to read. But yes, so as part of all that, it cost Walgreens 44 million years down the line. But I'm glad it's drawn a line under that. But it just seems the bad news just keeps pumping out for Walgreens lately. It's
Yeah.
really getting beaten down.
I was the other day thinking about creating like a yield sucker trading 2-on-2 pie, and throw Walgreens in there, throw Medical Property Trust in there, throw CVS in there, throw AT&T in there, Verizon,
Yeah.
and all this stuff in there, because you know, of course, I wouldn't do it, but I was just daydreaming a bit about that when I was driving from work, because I felt like, there is a case to be made that those companies could on any positive news, a year from now, at least recover a bit in share price. Of course, guys, I'm not doing this, yeah, but sometimes I'm in my mind, I'm having these thoughts like a yield sucker ETF, or the other time I was wondering, like, what companies do you put in a woke ETF, or which one do you put in such a kind of ETF? I'm always like, those are nice for me, nice like brain farts, let's say.
Yeah, but yeah, it's a tough one with Walgreens because it's getting into that territory where you feel the dividend is not sustainable. It's
Yeah.
actually it's tethering on the brink of that, which is tough. And then you have a lot of people like myself who was bought it at a certain price. It's probably dropped in half. So now you're looking at a big loss in terms of that. So I mean, it's tough. You think the business model will do well in America, but they're struggling, and there's a reason why they're struggling. So it might be a case that you have to kick the can and take it on the chin. But let's see.
Yeah. Good one. Well, the next news for me is actually another one, which is about settlement. Yeah.
Of course, it's all the news lately.
Yeah. I mean, these companies. I think we need to do the free cash flow to really understand the shareholder return. We need to look at not buybacks and dividends, but also settlements to really understand the cash outflow that are costing shareholders money in the end as well, right? But Philips is settling with the US about their respiratory devices, the issues that they had with the foam in there during COVID. The expected costs, according to Bloomberg, will be about $500 million. The US courts still need to approve this settlement, and then the first payments can happen in the first quarter of 2024. I think they want to pay it to the buyers of these machines, but I'm not entirely sure.
Okay.
It would be good for Philips to get it behind them. I don't know if this is covering the entire lawsuits that they have. I need to do a bit more digging on that. But yeah, I so much cross my fingers that Philips gets a little bit over this, because I mean, I don't know how it's for you, but it's a European company that, they made the famous televisions. We grew up with Philips products everywhere. You want them to do well. Yeah, it's such an iconic pride from the past that you hope can revive itself in the pharma space. It has been poorly managed by the former CEO. I really hope that this new how I say it, crown prince from internally from Philips we'll be able to make something out of this, because the history deserves better of this company.
I mean, you'd have to feel as European, if the litigation is settled and they get that out of the way, I don't feel like it would take much positive news to help this company or stock recover in terms of share price, because we know it's been beaten down pretty bad. But obviously they have a lot of hurdles and challenges along the way. But you're right, it's a European darling, so it would be nice to see them actually
Yeah,
turn
but
that
I'm not
shit
too bullish on Philips itself at all, because you could argue like, oh, before it was trading at 14, now it's trading at 19. We have also some people in the community that work with Philips devices, in the healthcare space, and one particularly that we know, this person really hates the devices to work with from usability point of view and everything, right? So there might be just more broken in this company when you think about it. But I would love to hear from other community members that are maybe working in the healthcare space using Philips devices, and what their opinion is. But when I hear such stories, I'm sensitive to that, because I think this defines the mode. Yeah, if the healthcare professionals find a machine easy to use, not all the time defects or something like that, that's what you want, because they will then recommend to their bosses, please buy more Philips. Yeah.
Yeah, no, it makes sense. Ease of use is probably one of the biggest things, especially in that area or department. You don't be there fiddling with a device and you're trying to care for
Yeah.
someone or give them a reading or whatever it is you need to do. So
Yeah.
yeah, let's see. But it's interesting. We've talked about stock price now on two companies, and it's not something we often prioritize here on Dividend Talk, because obviously Dividend Talk, we talk about dividends. But it was quite interesting this week with Apple. I see they've been in the news
It's
the
full
last
over
couple of
Twitter.
days.
Apple is 5% down, 5% down. And I'm looking at this, and these tweets get really high engagement, right? People are really sensitive to this. You know what I did? I put the week chart on there.
Yeah.
Yeah. Okay. 5% down. Then I put the month chart on there, minus 1%. I put the year chart on there, plus 13%. I mean, this shows, and this is being tweeted by high profile social media influencers that call themselves dividend growth investors. Yeah, they are tweeting this. Just zoom out to the month chart and it's -1. For me, this shows like you really need to watch out with social media figures here, because they consider themselves long-term investors, and they start tweeting about a 5% drop like it's the end of Apple. I mean, Ahold dropped in price this week, because of a downgrade 6%.
Yeah.
That's an opportunity as a long-term investor. You need to check why. So when you read it, they think like, okay, the bull period of food price inflation is over. So they downgraded a bunch of supermarket stocks, grocery chains, and I think like, fine, they will still do well. Boring business, very conservatively managed. They will do well. So if you liked it at 30 and you were hoping to get it at 28 or mid 28, nice opportunity to buy. I think I could still have it cheaper because I own already a lot. But then you're a long-term investment. Then price is your opportunity. But to buy Apple because it drops 5% and it's like -1 on the month after even a run-up earlier in the month, and then acting like, there's too much going on with Apple or something like that, and people start doing calculations and da-da-da. Yeah, that's for me just the insanity of the stock market, and it's a shame that some high-profile social media figures that call themselves dividend investors are using this, and there's even more to it, because I have a large following, almost 20,000, right? And what's happening now on social media or on Twitter is that if you get 1.5 million views on Twitter, they pay you. So I really dislike at the moment what I'm seeing, all these stupid engagement tweets that they know what triggers people. Yeah, but it's usually not good for people that are sensitive to that. Yeah, so it's I understand why Elon Musk introduces it. He wants more engagement, but these guys are really clever. They know how to get this engagement, but then you get all the shit out there on Twitter, and I hope this will turn around soon again, because it doesn't make FinTwit nicer, in my opinion.
Yeah, I mean, look, there's three arguments you could make here. One is you could argue you should just stay invested, because a lot of these accounts have said buy the dip. And I remember 2 years ago I was posting memes on buy the dip because I was sick of hearing it. Like
Yeah.
a stock goes up 20%, it drops 2%, and that's a buying opportunity. No, just buy the year ago when you were waiting to buy it. You don't
Yeah.
have to just buy the dip. So I think it is a good case to stay invested. It's also a case that don't just wait to buy the dips, which I think a lot of people do. I mean, even with Ahold there, you spoke about
Yeah.
Ahold. It's a good opportunity, but I mean, it's only dropped to $29, I think. You
Yeah.
could have got that last February for $26, $27. So it hasn't even dropped
Yeah.
back to the price it was in February.
Yeah. Yeah.
So what are you waiting for? That's what I'm kind of getting at. But yeah, Twitter, I struggle. I've struggled with Twitter for about a year, 2 years now. I don't post as much. You can see this,
Yeah.
and we used to joke offline, and I would say to you, watch, I can get 70 likes just by posting absolute rubbish, and I would, and
Yeah.
I would get 70 likes or 80 likes or whatever, and then I'd post something which you put a lot of time in, you put a lot of research in, you post a thread, and you might get 2 or 3 likes. And you're like, what's the point?
Yeah.
What's
Yeah.
the
Yeah.
point?
Yeah.
So I struggle with it. I am struggling with Twitter. I really only do it. I dip in and out of the messaging now, because that's where I actually talk to people, and I don't have to look at all the rubbish that's on my timeline, to be fair.
Yeah, true. Well, the Facebook group is often a breath of fresh air at the same time as well.
Yes, exactly. At least there, it's just all. It's actually pretty decent. It's actually all dividend investing, and there's no buy the dip or any of this kind of rubbish.
Exactly. A lot of kabooms when there are dividend hikes. Yeah, that's where we celebrate, and maybe that's a really nice bridge to get a more optimistic podcast here, because real estate investment trust VICI Properties, they just declared a dividend hike, right? What is it? 6.4%, and it will be 41.5 cents going forward. Are you owner of VICI?
Yeah. I think I've mentioned them a few times. I am an owner of VICI. I love the whole Las Vegas thing. We obviously had Brad on last week talking about them, not just in Vegas, but moving outside of Vegas, which I think I touched on before as well. And yeah, I'm quite happy with the 6% dividend increase. They have been a lot higher over the last 5 years. But as I was saying, I expected them to move down maybe towards the 5% mark. So 6.4%, I'm quite happy.
Yeah, so ticker symbol VICI for the people that don't know it, and can't understand your Irish accent. The next company is then Verizon Communications, ticker symbol VZ. They announced a quarterly dividend of 66.5 cents per share, up by 1.25 cents or 1.9% compared to last quarter. I think they did already 6-7 years in a row 2% hikes. I think it's what you expect from Verizon, right? High yield, low growth. This is the typical utility stock from the telecom. Yeah, for me, they act like a utility stock here. And now, what do you think about them? Because Verizon has also gone into a certain direction, like Walgreens. You could argue. I think many people are concerned about the debt and the impact of interest rates. What is your opinion about this stock in general?
Yeah, I mean, it's always one. It's well regarded, obviously, within the dividend growth community. They have a good yield. They have a very good track record, and they were compared to AT&T, and lots of people actually prefer them over AT&T.
Yeah,
but similar to AT&T, they have really high debt levels. Not as high as AT&T. So I think if you're looking in the communication space, they're probably one of the better ones. But it's that debt level that's really hard to ignore. And obviously with interest rates and inflation, and if they have to take on new debt, it's going to be expensive. And how do they do that? And to your point, I think in many shows ago we were talking about 5G, which is a catalyst for these guys. It's going to be very capital intensive for them, and there's probably going to be other players. But I honestly think the dividend is safe, even with the high debt, because I think you expect that with these types of companies. So if you're looking for a really high dividend and not much growth in it, maybe 1% a year, I honestly don't think I think there's worse options out there, to be honest with you.
What I appreciate about Verizon is that they didn't have the temptation like AT&T's management to squander with shareholder money by purchasing assets, spinning them off again, and just creating a mess out of their portfolio management.
Yeah,
Verizon has been quite stable over the years from that point of view. And, there's nothing wrong with having a boring job, I would say, if it makes shareholders happy.
yeah. I mean, they stayed in their lane.
Yeah.
They didn't. I mean, you had T-Mobile, you had AT&T all making dramatic moves and moving the market in different ways, and
Yeah.
they just kind of took the long road and just said, "We know what we're doing, and we just stay on that
Exactly.
path."
I appreciate it a lot in a stock because so easy to fall trap to wanting to be the CEO in the history books, but otherwise you end up like the AT&T CEO, more in the Guinness Book of Records, right? With a stupid thing.
Exactly.
But this is maybe also a really nice bridge then, because T-Mobile US is initiating a dividend for the first time. And I'm really intrigued by this. So they are initiating they have a whole capital appreciation or capital allocation program. So they are authorizing a 19 billion program over the next 5 years, 5 quarters till the end of 2024, if I'm correct there. And how you said, that includes the authorization of a 3 billion annual dividend. This 3 billion stands for approximately 2.55 annual dividend per share, which represents about 1.92% forward dividend yield, and they aim to grow the dividend by 10% in the upcoming years. Now, I've been really a big fan of ticker symbol TMUS in the past. I never bought it, but their CEO, John Legere, the old one, the CEO, I loved it. There was a CEO that came into the company with a hoodie and put the customer first in everything. He was really breaking through in the market with new plans and really challenging AT&T and Verizon, really grew from there. But then they did this merger. When was it? A few years ago. The guy stepped out as well. I forgot the company they merged with. And now I look at the balance sheet and it's becoming like a Verizon balance sheet. So it turns me off already when I look at it, specifically if it only gives you a 2% yield. Yeah, that's straight away my issue, because what I see there, I see the debt hiking after the acquisition much more than the equity. Yeah. So it means that they paid a lot of goodwill in here, which was just not giving really money to the shareholder. And at the same time, the cash flow didn't really go anywhere either as a result. So that's kind of disappointing for me in this acquisition, I would say.
Yeah, it's an interesting one that they're initiating a dividend now. It almost feels to me like management now believe that the really high growth phase is over, because they were really fast, they were really competitive, really fast growing, and now they've started the dividend. So they probably realized they're coming to the end of that growth cycle, and they need to give back to the shareholders in other ways. So look, it is a small yield relative to that market or that industry. But it's just interesting to see that. So, like you, I was disappointed when that CEO stepped down and when they did that merger. I think if he was still there and they did this, I'd be definitely interested. Just to own a few shares just because of him, but not anymore.
Yeah, and there's another dividend tie. Can you tell a bit more about that one?
Semiconductor giant, KLA Corporation. They have an impressive 11.5 dividend increase, which is their 14th annual consecutive dividend as well. I have to say, I don't know a whole lot about that company. I know semiconductors, we've spoke a lot about them. They've been in the news a lot last year, particularly. But like it's interesting to see a company like this with 14 years. So I know lots of people look at these dividend screeners. You have dividend aristocrats, dividend champions, and they're broke up into segments, aren't they? 0 to 10 years, 10 to 25. And you'd imagine with a 14-year streak, this will start coming up on more people's radars.
Yeah. Well, it's also really interesting that a semiconductor company is so bullish on their own dividend at the moment, because what you see mostly in this space that they are quite conservative at the moment. Also, I think Texas Instruments we will get later in this year still with a dividend hike. I'm really curious to that. I don't expect such a high one because their free cash flow is under pressure because of their investment. So it's really quite a self-confidence from this company to commit so much future free cash flow now, right? Their dividend payments.
Yeah, we'll see. Texas Instruments will give us probably a more clear indication of maybe the market is more bullish than we are at the moment.
Yeah, nice. Well, hey, but this was dividend hikes, and they're giving you more dividend income, right? That's the nice thing about it. So, what about the main topic of today? How do you feel after such a 14-hour workday? I mean, the floor is yours. I expect really kind of an Irish style, pub style, like they're all wankers and all of this kind of thing. So, let it all go, Derek. The floor is yours.
You can kind of tell when we're talking through the news, I was in a bit of a whiny, whinging mood. I have to say, it was a struggle. Like I finished work. I went in early. You finish, I think it's 14 hours. It's a long day. I think I don't even know if I got food into me. So it's just a really long day, and it's a struggle. It is a struggle. I don't know where most guys work, but I work in a manufacturing plant, and it's really high volume. And the problem with high volume is it's expected to run all the time. And if it stopped even for 5-10 minutes, you're getting phone calls, you're under pressure, you have to fix it now. We had a manufacturing plant down for like 12 hours of this 14 hours. It just would not work. So you could imagine the pressure that you're under to get that run going. So it's really, really stressful, I have to say. And sometimes you come back from work and you just sit down. Is it worth it? Is it? And that's genuinely what I think. Is it worth it? Like, I'm there as the expert, right, in my field in there, and all you're doing is getting hammered all the time. And it's things are out of your control. You can't obviously control everything, but is it worth it for me at the end of the day to go in there? What's meant to be a 9 to 5, remember, I'm only getting paid between 9 to 5 because I'm a salaried employee. So I'm only getting paid 8 hours, but I'm doing 14 hours. So I'm giving up 6 extra hours of my day for nothing, basically. And it's really frustrating, I have to say.
And can you do time for time? Like tomorrow, show up only 2 hours?
You get time for time. So everything I work over, you get time for time. But the problem is that I never get to use all of it. So last year, for example, I think I had 80 hours time for time worked up that I couldn't even take. I didn't have the time to take them. And at the moment, I'm up around 40, 50 hours already. And I do try and take it. When it's quiet, I take hours here, but it's just not possible to take it all the time.
Yeah. So, and I said, how do you deal with that then? Are you then, maybe stupid question, but are you then thinking the whole day about your dividend portfolio?
Not when you're in the moment, I have to say. so when you're there and you're looking in PLC code and you're trying to figure out why two machines that usually talk to each other are not talking, I don't think dividend income really comes into it. And it's probably one of the reasons dividend investing suits me more than, like, imagine trying to be an options trader that needs to watch the market on a day-by-day basis. It just wouldn't suit me. I just could not physically do it because I don't have access to my phone, or at least I wouldn't be able to pay attention to my phone on a regular basis to do that. So dividend investing is a lot more hands-off, so I don't have to think about it, luckily. And I think that's probably one of the reasons why it suits me better than other areas.
And how are you looking then at it? Because you're now getting a substantial dividend income as such. Does this also mean that you start thinking already about, for instance, taking a job with less stress, or maybe taking a 32-hour work week or something like that? Do those things come to your mind, or do you more think like, no, let's do this, let's get this through, more as a motivation maybe to work hard so that you get the maximum out of money and salary also out of it, so that you can stop earlier with working?
Yeah, so it's a bit of a conundrum. So I will whinge and I will moan about it. I give out to my wife sometimes and say I'm working too hard, I'm doing too much, and all this, right? But she makes a good point. If I wasn't doing that, I'm somebody that needs to keep busy probably all the time. Otherwise I get bored, and when I get bored, I kind of not go into a depression, but you don't feel yourself. So I like to keep busy and do that. I say I don't want to do it, and that's what I tell
Yeah.
myself. I don't want to do it, but actually, I think I would miss it if I wasn't in it. But
But
what
is it then also the purpose in it?
the purpose in it is more self-satisfaction. Like for example, today there's only 2 people in our whole plant. We have a plant with 3,000 employees. There's only 2 people today that could have fixed what went wrong today, and I
Mhm.
take great pride in that. That one of them is me.
Yeah.
So I do enjoy that. But in the moment, it's not so enjoyable, but I do take pride in my work. I think work should always come first. But what I don't like is that sometimes I miss family events. So my son had a match after, and it's the first match I've missed, I think, maybe in about a year and a bit. And
Mhm.
that probably upset me more than having to stay back 14 hours.
Yeah.
It's actually missing the family time, which is what you go to work for, isn't it? To make money,
Yeah.
to spend time with your family. So in that terms, I would like to work probably a normal 40-hour job with less pressure. It's still
Yeah.
challenging. I want something to challenge me, but something where
Yeah.
I know, okay, I'm going in at 8 o'clock in the morning, I'm finishing at 4 o'clock in the afternoon, and I'm done. But that's not the case at the moment.
Well, Sudoku can be quite challenging if you take the 3-star one or the 5-star.
I do quite like Sudoku as well. I do.
There you go. There you go. I thought so with your programmer's mind, but you touch effectively here on the topic of work-life balance, right?
Yeah.
And this is the thing, right? We are dividend investing. A typical journey takes, 15 to 20 years for the people that are really committed to it. But what you're doing at the moment is kind of sacrificing work-life balance. And it's nice to retire maybe in 15 or 20 years, but you're living now as well, right? So how do you look at that? Because it sounds a little bit like contradictory to work for freedom, but then to sacrifice so much freedom while you might already be able to gain a certain amount of freedom, right? And by
Yeah.
making changes that maybe push your financial independence date out, but at least the satisfaction more.
Of course. I think we build that into our budgets when we're doing things. And I know you joke with me sometimes because we do have to. We talk about consistency, remember, and we have to push a lot of these podcasts around because I spend a lot of time on the weekends either traveling or going away with my family, the kids, my wife. I'm doing something a lot of the time, so I am very conscious that during the week I'm not as present as maybe what a father should be or a husband should be because I'm working, and even when I'm at home, I'm either up here doing stuff on the podcast or newsletter or the blog, or I'm actually sitting on my laptop dialed into work doing stuff. So I'm usually 90% of my time during the week is work related in some capacity. So on the weekends, I do make a conscious effort to be present and to spend as little time as possible actually behind the computer or behind that. Because again, it's about setting an example for your kids. And if they see me sitting behind a computer 7 days a week, I can't really tell them, don't sit behind your Xbox for 7 days because it's contradictory. So I am very, very conscious of that and try to do that. So like this weekend, I have 2 days completely off. And we have a wedding to go to, weddings in Ireland. I don't know if you know, but it's usually a 2-day event. And the second day is always better than the wedding day. So it's
But I expect an invite when you get married.
Well, I'm already married, so maybe
no, but again, when you get married again.
Get married again. When we renew our vows, maybe. But it's so I'm looking forward to that. It's just going to be completely switched off. I leave my phone at home and just switch off for 2 days and just be present in that moment. I think that's important because you can get sucked in to social media, you can get sucked into your work, and you're just always on a screen. So I struggle. I do struggle with work-life balance. I think it's my biggest challenge at the moment is getting that right. And sometimes I get it right in terms of family, myself, in terms of gym, football, and work. But that's a short moment, and at the moment, I'm sacrificing myself because I don't think I've gone to the gym in 2 months. It's mainly about work, and then when I have time, spend it with the wife and kids.
Yeah, that's bad. That's bad. We got to talk to your manager.
Yeah, but I mean, you get to a certain stage in your career where you have to do that, don't you, to move up to that next level. Like I went in as as a junior in my company, I've moved up quite fast compared to my peers. I've actually outpaced a lot of my peers and got to a position. I'm not a manager, but I wouldn't say I'm regarded as a manager, but people will come to me before my manager because not that we're on the same level, but I have somewhat similar knowledge in technical terms as what he has.
Yeah.
He's 100 times better than me at many stuff, but it's nice to be regarded that way. But the next step for me would be to make that leap into management, and to do that, you have to be noticed. And to be noticed, sometimes you have to be in the trenches dealing with the shit, actually jumping up and complaining. So while the big bosses see you, they know your name, and then that's how you start getting into conversations to move up.
But do you feel that all the hard working pays off then?
No, not all the time. No, and this would differ, I would say, from company to company, I would imagine. Nobody knows where I work, so I can say this, but I do see colleagues in there that in different, because engineering is a big department. So I'm automation, but we do have mechanical guys with other guys, and there's some pretty talented guys that have left or are leaving for pretty much the same reason. They've overworked, they've burnt out, they've worked as hard as they can, and they can get more money and a less stressful life going somewhere else. And I think that's what happens. And I know a close friend of mine is leaving in 2 weeks for that exact reason, and he'll be a major loss to our company.
Yeah, that's bad, but it must motivate you as well.
That's what it does. It does give me motivation, and that's what keeps me going, particularly with the podcast and the investing. And look, we've made no secret. We're trying with this newsletter, for example, we're trying to break away from the mold and give ourselves some bit of freedom away from having to do all this. But it's definitely a motivational factor for me, not just for me, but for my kids. I don't want my kids to have to work for a multinational corporation like I did. I want them to have the freedom to work for themselves from day one and not have to try and build a life. So if I don't achieve it in my lifetime, I can accept that once my kids don't have to do it.
Yeah. Really speaks for you, I must say as well. And we'll get there. Anything else? I mean, I find this really inspiring. I hope the listeners as well to listen to you, because it's really, you're really opening up, Derek, and I think we haven't done that too often from that point of view.
Yeah, it's a personal journey, and sometimes we can make it feel like everything is easy or like everyone's life is just hunky dory. But I mean, there's lots of people that listen to us, for example, that work on oil fields, and they travel a lot more than I do away from family, and it must be difficult for those guys. I'd love to know how they keep their motivation, because I mean, I'm giving out. I only have to do this like every so often. I mean, the blog and the podcast is my choice. I don't have to do that. That's my choice. But in terms of work, I don't work 14-hour days every day. There's some people that have to do that. But I'd love to know how those people keep themselves.
I can tell you, I was traveling the whole world for work like 7 years ago or something like that.
Yeah.
I quit the job and I took a really, really large pay cut as well, because I felt like I worked so hard that I didn't live for 4 years. Simply, I was working 60 hours a week, traveled the whole world, but it meant I didn't see my child. I didn't see my wife a lot, and I calculated after 4 years, like, what have I actually done? And I couldn't sum it up. Yeah, I went on vacation, but I had no memories from it. It was like vague, all just because of all the work, the traveling, the jet lags. So I said, like, okay, it's not worth it. I resigned. There were a few other reasons why I also resigned, but that was definitely one of the biggest drivers. And I went somewhere else, and actually with the focus on work-life balance. And I found that at that time, and I could have been financially independent if I would have kept the old job now already. And I was already dividend investing then, and I started already then. But I don't regret it at all, because my work-life balance is in a really good shape. The company really cares about it, and it motivates me also to give me the full best. Yeah, and I work 8 hours, sometimes 12 hours on a day, but And yes, I'm tired, but I know that the company really cares about me, and they make sure that I've got everything that I need, and not only the best laptop or something like that, but also from a well-being point of view. And so I have a feeling that I found it, but I also feel very privileged with that, because I don't think there exist so many companies, and even within the company, so many departments where you have this management culture and where you have this approach to people. So I can really recommend to people, generally from my experience when I hear you talking as well, it's really not worth it. We live once.
Yeah.
We live once, and now are the years that my children are flourishing, let's say, and really become human beings. And to miss that's a shame. I rather work my ass off when they are out of house, and if I only
Yeah.
have to see my wife, then I don't need to see her the whole day.
I'm the exact same in that regards. Like I mentioned, even something small as a football match. I just don't like missing time or moments, because you'll never get that back ever. You'll always make money, but you'll never get that time back with your kids ever. They're only young for a certain period of time. So it's interesting to hear that you had to step back, and it must have been a hard decision, really. I know you talk about.
I would have been financially independent now, and I
Yeah.
knew that. I did the math. I could have done it in several years instead of 15 years because of the large pay I got at that time.
And what were your wife's thoughts? I know what my wife would say in that scenario. She would pretty much tell me to do what's best for me and forget about the money, because my wife is not into money. But was your wife supportive? Was it a hard discussion, or was
No, not at all. It is whatever you feel is best. I would love you to be the most home and to see you, and I don't care about the money. So, and that helps when you have supporting family. So, another life hack: marry a wife that is not too materialistic. That's what I can also say from experience. It so much helps. It really helps. No pressure at all. Actually, to the opposite. More like a confirmation, like that my thoughts are not stupid. Because around me, people were saying, EDGI, not with that because I wasn't blogging yet, but you're stupid to do this. And I said,
of
like,
course.
well, it's for me. I'm done. I don't want to be at a certain age and look back and I lost a decade. Yeah, come on. I don't know yet if we live in a simulation. Yeah. So it's quite a risk, right, to take that one.
Yeah. It's a big risk and a hard choice to take, but I think those who have ever done it, I would say very few would have many regrets.
Yeah, I think so. I have already no, I wouldn't call it regrets because I feel still like I acted on time. But still, if I knew what I knew now, I would have done that still different at the time by not working so much and probably quitting earlier at the time at that job.
Yeah.
And content wise, like what you have, the job was amazing. Yeah, the job was amazing content wise. It was really on the work pressure.
Yeah. I think it's happening in a lot of places, though, isn't it? It seems to be pressures. The demand for everything seems to be going up and up, and everywhere seems to be cost cutting. At least any industry that I'm involved in is cost cutting. Staff. I mean, our factory is after, I would say, quadrupling in size since I've been there.
Yeah.
And there's still the same amount of automation guys as it was when it was really small, and now we're covering a much larger space. So the pressure's there. But when I look around other industries or other factories, it's the same. And I talk to people, obviously I have friends in the industry, and you're talking, it seems to be the same across the board. It just seems to be in automation at the moment. And like tech was maybe 4 or 5 years ago, it's just really, really high pressure. There's a shortage of skills there, which means the people that are there can make a lot more money, but because there's not as many people,
it comes at a cost.
It comes at a cost. Yeah.
Well, we love it, of course, as dividend growth investors, because it means that the gross margins are going up and the dividends can be paid more. As long as it's sustainable.
Maybe that's where AI and robots come in. They can take my job. That's what's going to happen. They take 20 hours work off me.
Yeah. So it was a bit of a different topic, but I think it shows also a bit where your motivation for financially independence comes from, right? And why you're seeking it.
Yeah, exactly. I suppose if you don't have a goal or a reason for a goal, it's easy to get sidetracked, isn't it?
Yeah.
So
Good.
that's my
Hey,
motivation.
let's get back onto our feet again now. Or we may, let's say back to reality from another side, because it's the listeners' questions of the week, Derek. And the first one, to give you this happy thought to get out of this grind, what stocks do you plan to cover in the upcoming newsletter? Is the question.
Yeah, so we are trying to keep a more European feel to it, because I think there's a lot of content out there with US companies. I think your article last week on L'Oreal was the most in-depth article on L'Oreal I've ever read out there. I thought it was fantastic. This week I'm covering British American Tobacco. Was a cheat. It's a bit of both, but it is a UK company. So that's what I'm covering this week. And then I don't know. After that, I'm not quite sure. Maybe Louis Vuitton might be going up there, but we'll try and pick some European darlings to keep going with.
Yeah, for me, it's also like, what would you like to read? Tell us. Yeah, we will spend a lot of time on really grasping the company. It might, of course, also be a US one, but for the people that are really interested in the newsletter, just drop us an email. Email me at europeandgi@gmail.com and tell me what stock you would like me to put in the newsletter. It's full disclosure, though, we said that the first two will be for free, so the British American Tobaccos and then we will start introducing a subscription model. It will be we still need to land on something, so we'll let also people know what is included in that. It will not just only be the newsletter. There will be a bit more there to really give a lot of value for the money. But yeah, let me know what you would like to me to write on for the October issue.
Yeah. And then the same guy has asked us about Kering, and do we like it? Is it as much as a quality business as LVMH?
In my opinion, no. Louis Vuitton is a higher quality business than Kering. I checked out Kering the other day. It is quite okay. I understand that the yield is also much better at the moment. But after I did my screening, I didn't feel the urge to further analyze. I was already turned off. And I think it was probably a combination of dividends and just what the feeling I got from the overall business situation. You know, often I need to sometimes check my notes, but for some companies that I do through the screener, I don't even make notes because I do this in 10, 15 minutes. Think, okay, not even worth it to spend more time on. And Kering fell in that category for me.
Yeah.
That's, yeah.
And I think the next question from Joris is actually a good follow-up question for this. He's saying that many YouTube channels give advice on dividend growth stocks based on the historic information, which is what your dividend screener would typically look at.
Yeah.
But history is history, and it's all about the future. If you must use one metric to calculate future growth, what would your choice be?
Well, actually, I do that in my videos as well. It's the payout ratio.
Okay. So you look at
so yeah, if the company shows consistency, like something like Johnson & Johnson, every year 6-7%, I do believe that the probability is higher that they want to continue that trend. But they can only do it if they have the supporting free cash flow. A company like Johnson & Johnson has it with a 50% payout. So I think the likelihood is really high that they will continue that track record if they have been doing that already for 2 decades or something like that. So, but if the payout ratio is higher than normally, and they have been, let's say, doing it historically at a 10%, let's take Medtronic. Medtronic was doing it for 7% or something like that for many years. I wrote an article about it in 2020, and I predicted their maximum 4 or 5% they can do because they don't have more wiggle room. Yeah, and then I model with something like 3 or 4%, whatever it is here. If you do, for instance, a dividend discount model as an example, or even a cash flow model, because you just see it's not possible. Yeah, and so that's the assuming here that it's about the dividend discount model. If you use the the discounted cash flow model, it's for me first looking at the business, understanding do they have even room to grow, and why were they growing so like that in the last 5 years? Maybe they were growing so fast because of the COVID boom. maybe they were not growing fast because they were doing a turnaround. So maybe the growth should be higher going forward. So we cannot predict. History is, I think, a good indication of what management might want to do. But we also know that management is often handcuffed. So, and you can just check it. Sometimes the covenants for real estate investment trust even tell you our debt level may not be more than that. And then you look at the dividends, and you know they can't. They need to go almost in debt or whatever to pay. You know they will break the covenant, so you know they can't do it. So you know that the dividend growth will be lower if they can't do it via earnings.
Really, what you're saying, really what you're looking for is some sort of competitive advantage. Why have they grown in the last 5 years, and can they continue to do that in the next 5 years? Is really what you're looking at.
Yeah, exactly. And most of the times, I come to the conclusion not.
Good. And Joris has also asked us, he's going on vacation soon. Any advice for a good book about dividend growth investing?
No, I can't tell you, but I reread The Richest Man from Babylon in the summer, and I really loved it. It was the right timing. It taught me a little bit again how to deal with my kids about making them wiser. It's an old kind of a story, right? Here, more like a legend or a fairy tale kind of style, Americanized a little bit, but I really, really liked it. There were so many good things in there, again, as reminders. And sometimes it's good to read stuff that you know already, but to strengthen the message again in your head.
I have 2 books that I'm reading that are not quite dividend growth focused. One is on valuation. It's called The Education of a Value Investor. It's more like stories of this value investor. He does give you some valuation tips, but it's actually a really pleasant read. And I'm reading that concurrently with the Educated REIT Investing book that I've mentioned before as well. I think I've linked to that on Facebook. So I'm reading those 2, but they are 2 nice books, I would say.
Well, I can tell you, if yours is lying beside the swimming pool, don't expect any women to come to you when you're reading this book. They wouldn't even know what to talk about, because usually they could look at the book cover and think like, oh, this is an anchor that I can start a conversation. But when it's this, yeah.
My wife will be happy. Salaman has asked us about Louis Vuitton, LVMH, and ASML. Have we got any updates and targets on these guys?
No, I don't have any updates on targets, but I think ASML under 600 is generally probably a fair price, but don't expect a lot of capital appreciation in the upcoming time then. Louis Vuitton, I haven't checked them out lately. I really need to look into them. It's the second one that gets compared to it. I heard also here that the share price has been tanking a bit lately, so I guess this is why the question is coming up.
Yeah, they've been coming up quite a lot, and they've tanked. They're down as far as €731 at the moment, which is level at about maybe January of this year. So they've come back to where they were at the start of the year, pretty much.
Okay.
But, I don't know the reason. I honestly, I'm not following them too closely, but this is the second or third week they're coming up, so there must be some sort of reason why it's declining, and maybe honestly, it might be worth for us to actually look into that and see why.
Yeah.
Jay has asked us, how do you plan to offset the tax liability as your portfolio grows?
No, tax is part of my calculation, right? I just accept that I need to pay dividend tax. So, that's it.
Yeah. Jay has an Irish surname here, as you can read, and it's quite a popular topic and question over here in Ireland. It's actually one of the main questions you will get asked about, and one of the main disadvantages given for dividend growth investing over, say, paying down your mortgage.
So it's the Irish context
and stuff like that. But like you, for me, I look at it, I know what I'm earning, I know the tax bracket, and we pay dividend withholding tax anyway, and then at the end of the year, I just file my taxes and pay what I need. As I get more and more income, I'd probably just keep a little bit aside in my portfolio, but not my portfolio, my bank account. But at the moment, even I can easily cover whatever tax liability
Yeah.
on a monthly basis. So it's not a problem.
Yeah.
Simon has asked us, hypothetically speaking, if you only had to hold one stock in your brokerage for the rest of your investing journey, what would you pick?
Yeah, and he also mentioned this question requires 150% conviction at the time of answering. And I've spent like a few good minutes thinking about this, and I passed a lot of stocks. And you know which one will surprise you that came to my mind? And where I really have the conviction? Unilever.
Wow.
From all the companies that I have in my portfolio, and I think about 40, 50 years, I have the strongest conviction that, let's say, by the end of the century, Unilever will still exist and will be able to pay a dividend because they produce so many elementary goods. Because I was thinking about Microsoft, I thought like, yeah, no, but this information technology sector, these come and go. Maybe it is the next IBM in 20 years from now. I don't think now, but who maybe Satya Nadella steps out, another idiot like Steve Ballmer comes in, who knows? Yeah, and then I thought like, maybe Ahold, and I thought like, well, Ahold had the fraud in the beginning of 2000. They might spin off this business from the US and Bol.com. So I was thinking like maybe then after that they will get acquired or something like that. And I thought like Unilever learned from the 3G Capital to put more defense structures in there to avoid being acquired. Then I thought about utilities, and I thought like, well, I don't really know utilities that so well. I thought a real estate investment trust. I felt like I don't know. I don't trust the sector well enough to in 40, 50 years. So all in all, I had to pick a consumer staple with that thinking, and I came to Unilever. But if I would have had Coca-Cola, I might have chosen that one.
Yeah, it's actually when you were speaking, Coca-Cola came to my mind based on all the different areas that you said. If you were to pick a company that will be there in 50 years' time, you bet your bottom dollar, Coca-Cola would be. It's interesting you mentioned REITs and you don't trust the sector. If I was to pick one in that sector, it would probably be VICI, because I think Las Vegas is not going anywhere. I think in 40 or 50 years, it's just part of the culture there, and they own pretty much all of that.
Yeah.
So if I was to pick a real estate investment trust, I would pick that. But
this is also interesting, right? Because I have a policy of not really selling my dividend stocks. But believe me, I don't. From all the stocks that I have now, I can imagine that it looks 70 to 80% different 30 years from now. Because companies get acquired. Some companies will get in trouble that either need to cut the dividend or I believe the dividend is not sustainable. And I will start, like 3M as an example. And if this happens like once a year with a stock in your portfolio and you have like 40 to 50 stocks, you're talking about 30, easily 30 stocks after 30 years, right? So I do believe that there are changes just happening because the cycle of life, the cycle of a business. But it's something I probably need to think about once a year about one stock. That's why I think still like a buy and a hold position, but it doesn't mean that a buy and a hold after 30 years will look the same. Even if you look at the S&P 500s from 100 years ago and how the Dow Jones 100 years ago and now, what is it? One stock maybe there still in there or something like that. So,
I mean, technology changes, people changes, habits change, consumer behavior changes. There's so many variables in it. So look at Intel, look at Microsoft. They were dead. Microsoft was dead 10 years ago, and look what happened. What's to say that they won't go back to where they were before? So I think you mentioned it before. It's not buy and hold; it's buy, hold, and review.
Yeah, exactly.
Review it, but
and then sometimes you add regret.
Yes, and regret, yes. But usually, like in the case of 3M, it's you can see it coming. You can see. I mean, the writing is on the wall there. It looks like they'll have to cut the dividend at some point. It really does. And then it'll be a good choice. Or they settle and they don't have to cut the dividend and they turn around. But even if they do that, there's still plenty of opportunities to get in to those guys. It's not as if they're going to double in share price overnight. So
I would expect not, no.
The next question is from Rayhan, and he has asked us, how did you both prioritize own home versus dividend portfolio? What are your suggestions when one has 50% invested in dividend portfolio and 50% cash and liquid funds? Move all and buy a home or invest more?
Oh wow, yeah, this is such a personal discussion, and there we need more context about the interest rate and such that you can get. Look, I don't know how it's for you, but I really started investing also after I bought a home and had my home already paid down to a certain level, that you actually also start to think automatically about what else can I do with my money. Yeah. So I never have been in that situation. So I don't feel that I'm the right person to mention something meaningful on this, because these are life decisions that people will be making. Generally speaking, I would say, so what I don't know if I would do it, but what I could envision doing is like, yeah, buy a dream house. I mean, if this is your dream house on this nicest spot on the planet, we spoke about today about work-life balance and enjoying life. If this home brings it to you, I think generally a home in a relatively good location should do quite okay over time. But then just make sure like it's not more than 20% or something like that of your expenses, and make sure that I would say if it's about 5% mortgage, just try to pay down as much as possible here, because it's for me a high yield debt, high interest debt. But try to get the expenses under 20% at least, and preferably even towards 10%. Because then also, when you want to reach financial independence with dividend investing, you don't have suddenly still your mortgage to be paid within that money for quite a significant amount of dollars. But that's probably how I look about it, how I look at it.
It's such a hard question to give advice on, because, as you said, there's so many different factors. Your age, are you married? Have you got kids? Where do you want to settle? Do you want to settle where your kids have nice schools, nice social clubs, or and so on? So there's so many different questions to ask there. But like you, I didn't start investing until after I had bought a house, but that wasn't by choice. I didn't actually sit down and design it that way. It just happened.
Yeah, for me as well.
I bought a house first, and then, like you get to a point where you have excess cash. You can either pay it down off your mortgage, or you can do something else with it. And I wanted to do something else with it. But if hypothetically, in my situation, if I was sitting here with 50% of my total wealth in dividend portfolio and 50% cash, I would not liquidate all that just to buy a house. I would use the cash to take out a mortgage, even if it's slightly higher, to take out a mortgage and buy my home. But I would still stay invested in what I have. And maybe I would not add to that, but I would let it sit there and just reinvest my dividends. Maybe that's probably what I would do. I wouldn't liquidate it, but again, that's my situation. I wouldn't suggest that to Rajan, because I don't know that his circumstances. Hussein has asked us, he needs some confirmation. 33 years of age, and he said he is enlightened very late. So I'm guessing he just came on this investment journey very late. He's now looking to buy his first house and needs to put all his savings there for at least 8 to 9 months. Is it okay to get this kind of a break in the journey, or should he invest no matter what?
Oh, come on. Of course you can give yourself a break. I mean, just you need to be realistic and recalculate your financial independence date, right? Because if you do the math, you say like, okay, if I invest 50% of my salary, after 15 years I will be financially independent. Okay, it will be 16 years. Yeah, that's the consequence of it. I
mean, there's no hard and fast rules in this game, right? And everybody posts. I think Mr. Free at 33 maybe gave an ideology that you have to be retired really super early, but there's no really hard and fast rules. It's everybody's personal journey. So whatever you're comfortable with, whatever you're happy with, that's what you should be aiming for. And if that means not investing for a year, 5 years, don't invest for 5 years. Buy your house, buy your dream home, save for whatever amount of time you have. And then that's the beauty of it, isn't it? It's a personal journey. Jump back on the bandwagon when you can and
But
see where
what I would like to highlight is that for me, discipline is really important. Discipline even gives me the motivation. So whether it's investing in your portfolio or investing it in making sure you get all the cash together and saving it for your mortgage, the discipline that you do it, I think it is important. So let's say like that, in my opinion, I'll make sure 50% of my salary, when it hits my bank, straight away goes to my investment account so that I invest it. If I would need to do something else like save it up, I would straight away put 50% to my savings account, so that at least lifestyle inflation doesn't creep in and these kinds of stuff. Yeah, because it is important for wealth building. Because if you're investing in your house, buying your first house, you're still increasing your net worth with all of this and building your net worth. So I think that is something that I would really emphasize. That probably is important for many people, is the consistency and the discipline. But then it's more like, as a CEO, a capital allocation decision. Do I pay dividends? Do I buy back shares? Do I pay down debt? You know, that's what it comes down to.
Yeah, but again, it's always a personal decision, isn't it? There's no right or wrong answer. It's whatever's right for you in that moment. But yes, discipline, I think, is super important, especially if you have a set date that you want to reach a target by. If you're not disciplined, it's definitely a lot harder to do so. Marek has asked us, what paid dividend makes you happy the most? Which company?
Shell, because it's at such an amount that I can reinvest, and I see several shares. And then if you look after a year, you see the share count growing, and you think like, damn, it's really snowballing. So for me, Shell anytime. And every time when I go to the gas station, I'm putting it in, and I think like, this has been paid for, you know?
Mine is actually Realty Income. It's because they pay every single month, and it's always, like on the Giro, you can check your upcoming ones. It's always the first one I look for, even though I know it's going to be there every month. I think it's just a habit that I check, and I see that they're going to pay out the next month. It's my favorite one by far.
Nice.
Dennis has asked us a good question. He's asked us, a lot of countries offer one or more tax-friendly programs, such as retirement programs. So would you prefer to utilize one of these strategies, or would you prefer your dividend growth portfolio?
Yeah. So we have this in Poland as well, and I have one there. But still, my priority is the normal dividend growth portfolio, because I don't want to wait until I'm 60 with having access to that money, let's say. And so therefore I do pay tax now, on capital gains, let's say, because that's where the real benefit is, but also some dividend tax. And but I don't want to wait till 60 to live off that money.
Yeah. And you always feel more in control with your own portfolio. If you're waiting on retirement, I mean, just Google Waterford Crystal pension. Just Google it, and you'll see what happened to lots of people who live in close by to where I am. They couldn't access their pensions, and when some of them did, they had died, and they never got to see that money. And maybe their families did, but they didn't even get the full amount. And that has always left a lasting impression on me in terms of pension schemes and all this. And it's really drove me to want to have to do it myself. And look, we spoke about the risks of brokerages. It doesn't mean what we're doing is perfect and there's not risks. I just feel a little bit more in control. And if, touch wood, I never had to, but if I had to access that money tomorrow, I could, in theory, take all that out and have access to that money.
Yeah. But I would say, like, if you, so with my wife, we max it out, here, because hopefully I will still be alive when I'm 60. So it's okay for me to have some money that we need to wait on there and have tax benefit. but it's more like an add-on to it because
Yeah.
I'm focused on the normal dividends first.
Yeah, we have a matched one from the company, so whatever I
Yeah.
pay in, they pay double. So it make no sense if I didn't take advantage of that. But I never use that in any of my calculations. So that's
same I have.
yeah, it'll be just an added bonus when I get to that age. And I go, hey, I get an extra few
Yeah.
And then there was a related stock question there. What is your opinion on Phoenix Group Holdings, ticker symbol PHNX? I'm not too sure. I think he mentions they're a UK-based company that's engaged in long-term savings and retirement businesses. I've never heard of the company, I have to say. I don't know if you have or haven't.
No. Let's look it up and discuss it in an upcoming podcast for a moment.
Okay.
Good. Hey, Derek, thank you. I really enjoyed this podcast. I think we spoke a lot. I hope people didn't fall asleep behind the steering wheel or while they were walking didn't hit someone else or something like that while running. So, guys, thank you so much always for sticking with us. We can just see it. You guys are so loyal to the podcast, and we really, really appreciate it. Thank you so much, and we wish you all a good week. Lots of wealth, lots of dividends. Keep on reinvesting them, and see you on the next show.
See you on the inside. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.